Thanks for joining us today on Market Call. I'm Morello Fernandez. Greg Newman with us on the show, Senior Wealth Advisor and Portfolio Manager at Newman Group Scotia Wealth. He'll take your questions today on North American equities and wealth protection strategies. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. You can email your questions in as well. marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Yeah, good to see you.
So the TSX had another record close yesterday.
Yeah.
It could beat the S&P 500 this year, so
Yes.
that looks good.
Yeah.
What is driving the momentum over the last few months for the TSX?
Yeah, no, great question. I mean, first of all, pent up, right? Because we've underperformed for so many years. So there's going to be times, TSX is pretty lumpy, and there's going to be times when we actually outperform, which is great. Our concentration to golds, our concentration to metals, copper, our concentration to banks and financials, which have done extraordinary, recently, and just had great earnings as well. So it's really those three areas. And then you also got natural gas, which is finally in a bull market after, years of slumber, which is great. And then you've got a lot of Canadian tailwinds with these nation-building projects that are going to be very stimulative, and they're going to create a lot of multiplier effects. So they're getting investors pretty excited. And we got a lot of power companies as well, that have been stable places, but all of a sudden now with the data center push, they're fueling a lot of that build out as well. So you put it all together, and the TSX has been just stunning.
Strong Canadian job numbers and growth in GDP as well. Do you think that at the start of the year we were just overly concerned about tariffs, or because of the CUSMA carve-outs we sort of slid through with less damage than we anticipated?
Yeah, listen, it was a very scary, rocky year. You had in April Peter Navarro of the Trump administration basically saying we are going to do a financial reordering, calling out investors, saying, you guys have had 40 years of great times, Main Street hasn't, we're going to right this ship. So it was very scary. Exactly. CUSMA is about 93% of the goods that flow over the border. And, it's like the tiger that roared, or whatever that expression is. Trump really did tame down a lot of the tariff rhetoric to a point where I guess you can claim a victory, but goods are still going through, and there hasn't been too many higher costs for Canadians, and we really haven't seen that much inflation. So yes, the Canadian economy has been solid, and we just got more evidence of that today.
Yeah, the hits have been very sector specific, definitely. Okay, we're going to take a break. We'll line up the first phone calls and emails for Greg Newman. He's Senior Wealth Advisor, Portfolio Manager at Newman Group Scotia Wealth. Again, I'll take your questions today on North American equities and on wealth protection strategies. Back in a moment. Welcome back. Let's start with an email today from Thor. He says, what are your thoughts on Netflix? What a day to ask about Netflix, which it got a deal in place to get Warner Brothers, or a little caveat for in case the deal doesn't finalize. But a big day in the entertainment industry. Netflix actually started going down earlier on the news, so investors aren't liking it.
Well, no, you know what? Usually the acquiring stock does fall, right? Because it's the merger arbitrage. So that's normal. The fact that Netflix is going up now is really reflecting the fact that there's there's going to be incredible regulatory scrutiny. I'm saying this deal is not going to get done. It's really not going to get done. It's too anti-competitive. The White House has already said they're taking a dim view of it. So, and if they do get it through, it's going to, and I know I'm early to say this, but it's not likely to happen. So, but if it does happen, the 1 in 3 or the 1 in 4, it would be incredible for Netflix. I mean, you're talking about a 100-year library some of the best movies ever.
Casablanca, Dirty Harry, all of the classics.
Yeah, and I was just watching, and Giant was on, and the James Dean and all that. So there's like so much that, and Netflix is so creative; they can bring that back in a new way. But the merits of Netflix, look, last quarter, they missed on some Brazilian tax issues, which were one-time in nature. So the company missed their earnings. They do have big competition. Amazon, I think, is Disney, HBO, Peacock. But their Q3 were the best sales ever. Their revenue was up 17% year over year. They raised their guidance, which investors always like. And they're really aiming to double their revenues by 2030. And this is any news of this deal. So, and they're also trying to leverage generative AI. So you put it all together, this is a company growing at around 20%, trading at around 27 times, still really good value here. So I would have been buying it this morning when it was down. I'm not sure if it's up right now, but I think it's still in buy territory.
Yeah, it looks like it is still down, but you'd still buy it this morning.
I would buy it right now, yeah.
All right, good to know. Let's go to Kara. Email she has written in to say, is Well Health a buy, hold, or sell? Thanks for that. Well Health, do they oversee medical facilities? Is that what they do?
Yeah, so if you go in and you do your blood tests, they do that, and they have health clinics here and in the United States, and they've got that, and they continue to buy. Right now, they're being investigated for some of their mergers as being anti-competitive, so that's something that investors got to deal with. But their Q3 was in line, and they had strength in U.S. patient and in their software as a service segments. They affirmed their outlook. Their margins beat 16.4 versus 15.5. The revenue growth was up 56% year over year. Their organic growth was up 19%. Of the analysts that cover them, 10 upgraded the stock over the last 60 days and none down. So, the knock on the stock is, I'll say that because of their acquisitions, their earnings outlook is not steady and up, but it is very, very cheap at 9.5 times 2027. So for riskier, more speculative capital, this is a name that I would own in the non-registered account.
Okay. All right, let's move on to the phone lines. And Chad is on the line. He's in Saskatoon. He's got a question today. Hi, Chad.
Hi, good morning, Marella and Greg. My question is regarding cargo jet. Would you buy at this level? And also, do you like this sector, being that TFI and this one is down? Would you add to these? Okay. I'll hang up and listen. Thank you.
Thank you. So transportation, kind of a difficult area right now, we'll say. Yep. Cargo jet's down to about $79.67 or $80 is where we have it right now on the TSX, and down 32% over the year.
Yeah.
TFI also greatly down. Would you buy in right now? Is there an expected recovery for transportation in the near future?
Yeah, both of these names, especially cargo jet. I mean, TFI is great. They always got a merger and acquisition model. They do something creative. They fix their balance sheet, over time, and then they go and they do it again. And meantime, you have the cyclicality. And so when transports are depressed, usually you want to be looking at a time to add. And the same is for cargo jet. These guys do have a moat. They do the, most of the Amazon shipping. It is a very capital intensive company, which is, something that investors have to deal with. But they got to the point where I think when they were dipping down below 70, that they were just far too cheap. And I think that these stocks that are down year to date, because most things are up and people are looking for tax loss selling relief, they're really piling in. And there's this vortex of just names that are down year to date that are just getting tossed out for tax loss selling. So I think all things equal, you take that away, and in January, the stock's up 10, 15% just on that alone. But, they've got a CEO transition. As trade normalizes, I think you're going to see a reacceleration in growth. So all things being equal, trading at around 15 times 2027, modeling about 14% growth. not a bad name to be putting money into right now.
All right, we are going to take a quick break. We will be back with Greg Newman, Senior Wealth Advisor, Portfolio Manager, Newman Group, Scotia McLeod. Again, he's taking your questions on North American equities and wealth protection strategies. We're back in just a moment. Welcome back. We have an email to start here with Chuck, He says, what's your outlook for Allied Properties? Has the stock price bottomed out, and is the dividend sustainable? Allied Properties, like a lot in the same space, also quite beaten down.
Yeah.
What do you think about Allied? Is it down as far as it's going to go? And I guess people are questioning the dividend because there's been a lot of sort of dividends being looked at to cut or cut. And so people want to know how sustainable.
Well, they cut it. Yeah. They cut it, I think, Monday. And they cut it deeper than expected. So they cut it by 60%. And at this point, it's a little bit disappointing because it's hard to say if they did it because the fundamentals are getting worse or they're just trying to be conservative. They didn't give any forward guidance, so that's the part that's kind of hard to tell if we're at the bottom. And I do think that it's being exacerbated by this tax loss selling vortex that we're in. But the stock did rally on the news, which is always a good sign. When you do have a cut, often you see the stock rally because that's part of the longer-term solution, and
investors are relieved, maybe.
Relieved, and the balance sheet's going to get better, and the business will eventually heal. I think that there's probably not a lot of downside from here. It is pretty cheap, but there's
$12.82 today.
$12.82, and it's probably going to go nowhere in the next month as long as tax loss selling is going on. And look, you're going to have to see some catalysts, and the key for this stock is you got to see some occupancy gains, and they got to get beyond 90%. There's a lot of tax loss casualties out there. This is one of them.
Okay. Let's go to the phone lines then. Elizabeth is on the line. She is in Edmonton with a question. Hi, Elizabeth.
Good morning. I would like Greg's update on Abex Technologies. I own a small position, and I'm wondering at what price I might add a little more because of the good news that has come for the company lately.
Okay. Thank you for the question. They do software tools, essentially, for communications and trade kind of thing?
Yeah, what they do is think about the ICE exchange. You know, they're basically like an exchange, but in Singapore for a lot of commodities that, they're competing with that sort of thing. So who are these guys? Look, there's no real earnings yet. It's a very speculative company. This is something that, I've been talking about since $9, $6. I met with management early on a couple of years ago, and I was very impressed with what they had with a moat and a model, and, the research coverage has come. It's a very lumpy stock, and I think that they were just going to be included or possibly in the TSX, and I don't think that happened. So the stock had a pretty big pullback over the last few days from like the mid 50s to
it's 48 today, yes.
47, 48. So look, if you're doing this in your RSP, please don't. But if you're doing this in non-registered account and you're looking for, and you don't mind having a loss if something doesn't work out in a straight line, I think this is a good stock to bet on.
Okay, you still think there's more upside. You said you invested it, or you were looking at it with
I would add
$9.
I would add a $47. This is a stock that, if it goes right, can become something like a nice exchange. It could be tenfold from here.
Okay.
So, but like whenever you're going for these moonshots, you don't always get to the moon. So you got to be careful.
All right. Let's go to Larry on the line in Toronto with a question. Hi, Larry.
Hi. Good afternoon, Marilla and Greg. Greg, my question is on Bank of Nova Scotia, and I'm someone in his early 60s, and I'm not looking for a lot of drama in my portfolio, and I've just gone to the big 5 banks, and I've overweighted Scotia a bit as a bond proxy because of the relative largeness of its dividend. I'm just wondering, with interest rates predicted to decrease, perhaps it might be supportive of Bank of Nova Scotia's stock price, and if they do a dividend raise later, it'll be even better. Anyways, I'm in the big 5 banks, and what do you think of Bank of Nova Scotia? Thank you.
Okay, thank you for the question. All the big banks, of course, reporting earnings,
Yeah.
all of them doing well in
Very
wealth
well.
management and credit markets, of course.
Yep.
Where does Scotia stand?
Well, I work there, so I shouldn't really be discussing, the merits of BNS, but I'm going to talk about the sector. And I'm
Okay.
going to say, look, they just had great numbers across the board. A lot of them are raising their dividend, but ROEs are improving. What's happening? The yield curve is more upward sloping, and that's helping. PCLs, which have been a concern, provisions for credit losses.
That has passed?
It's not passed. They've ticked up slightly, but less than what the market expect. Growth numbers have been better than expected. We're upping our numbers on our earnings expectations for just across the board, just about all of them. I think they're all looking good here. They are, and they all have their different nuances and different catalysts. And look, when I go for banks, I look for dividend. I look for growth at the most reasonable price, and Bank of Nova Scotia has that. So it's really looking very good here. And even though it's had this big run, I think that there's more to go. But I also like BMO here, and they're all going to do okay in this environment.
What do you think of the strategy he has where he's put his money in all the banks?
Well, that's fine.
Okay.
That's great. Like they're all good and they take turns. And you might want to listen. If you're an asset manager, you try to figure out the ones that's cheaper than the rest. And but it can certainly work over time. And the truism that banks just go up over time. Well, they kind of do, but not in a straight line. And not all of them, right? You look at some of the world's biggest banks and what happened to them, 15 years ago in the United States. So you can't just have your blinders on.
Okay. All right. We have to get to John now. He's on the line in Regina with a question today. Hi, John.
Good morning. Greg, following up on your theme of tax loss selling, could you maybe list a couple of your highest conviction names that you think has been unfairly punished this season that is due for a good rebound in the new year? Thank you.
Okay, that's an interesting question.
What an awesome question. That's a great question. Okay, I got a whole bunch. I think, and the magic words in investing is always all things equal. That is that the news by January is the same on the stock and on the macro. But, probably TELUS would be number one. BCE is in there right now getting overly punished. Names like Air Canada, Maple Leaf Foods, Propel is really, gotten
beaten down,
bludgeoned. Go Easy, another one. Transforce, Cargojet, and West Fraser, which just took down some of their operations a little bit, cut their OSB capacity. But all these stocks, I think, are cheaper than they ought to be. And if you want to take some risk, like real risk, Dye & Durham. That's probably not. That's a whole separate risk category, and maybe New Flyer as well. Again, very, very high risk. But all things being equal, those should be higher in January than they are now.
Interesting. Okay, let's leave it there for now. We've got to take a quick break. But when we come back, we will have a look at Greg's past picks. That's coming up next. Time now to go through past picks with Greg Newman. These are from December of 2024, December 19th to be exact. At the time, Propel Holdings was recommended at $35.90. It's down at $26.18, a 27% drop, a 25% total return drop. This is one of the stocks you had just mentioned that you think is going to have a comeback. It's been too beaten down. Explain what happened here.
Good stocks have a way of shaking people out, but really what happened was two events. Number one, you had a short seller report that came around about a new Go Easy about extend and pretend strategies, basically calling into question their accounting and arguing that they're being too aggressive and that these guys who are subprime lenders are going to have a reckoning. And you know what? So Propel, what they did is they actually cleaned up their book a little bit, focused a little bit more on quality as opposed to growth. And the market didn't like that. And these are pretty thinly traded stocks. So, a little bit of bad news can really let them fall a lot. And good stocks, I'm serious, have a way of really shaking people out. And this is a meritorious story. I mean, even though they're growing a little bit less post Q3, we're still modeling 35% growth, trading at 7 times 2027. I mean, this is really good value. I mean, if the company is reporting, if what we're reading is true, which we have every, reason to believe that it is, then this is just a matter of time. And I actually did sell this for tax loss selling. I mean, we had so many big wins, and we don't want to pay 25% come next April, but when to go easy instead, or going to buy this back in 30 days. So believe in the name.
Okay, Propel Holdings, of course, average price I have here is $31.07, and it's down today to about just short of $26. Yep. Let's move on to your next past pick, which is Kyndryl Holdings, Katie on the New York Stock Exchange at $34.18 US at the time it was recommended, $26.40 today, so 22% down for both return and total return. And they do sort of applications, AI, data, cloud storage, but they're a holding company essentially.
Yeah, I mean, they're a spin out from IBM, and their top customers are all the companies that the biggest in the world. And, they do all that IT, infrastructure, cloud, security, networks, app data. But, the reason why investors have taken a dim view is there's been an aversion to software names. There's been this swelling into AI, those that are really AI heavy, and, names like this to Constellation, to Gib.A. I mean, they've all had, Adobe, they've all had a tough time. So is this a meritorious play? Yes, the buyback continues. At the time, I was looking for names that are really cheap relative to their growth. We still model 59% compound annual growth, trading at around 7 times 2027. This is, as I say, very strong partnerships with Microsoft, AWS, Google. Very strong balance sheet. I don't think this is a question of if, but when. So you can buy it.
Okay, let's move to your third pick then. At December of last year, it was Citigroup on the New York Stock Exchange, $68.42 when it was recommended US, and now to $108.61. So 59% upside with return, 62.5 total return. Clearly a bank that is doing very well. Do you see continued growth? Did you trim it all? For
no, not trimming. But look, they just beat and they raised on their latest quarter. They're showing operating leverage growth across all segments, solid investment banking. I mean, it's kind of like it sounds the same for all the banks. The thing about these guys were they came from a real bad situation on return on tangible credit. Return on tangible common equity. And they're trying to get that up to 12.5%. And so this is a cost-cutting story combined with a macro that is really improving. And everything that we saw in the last print really confirms our convictions that they're executing on that transition. Shake it all out, 9 times 2027, growing at 26%. So still more in the tank to go.
All right, we will leave it there for this block. We will line up more questions and emails for Greg Newman. We're back in just a moment. Stay tuned. Welcome back, and thanks for joining us today. Andrew is on the line in Waterloo, Ontario, with a question today for Greg. Hi, Andrew. Andrew, are you there? Okay, we might have lost him. The question, I believe, was about Constellation Software, which we've had a few questions about. Yep. The CEO, of course, stepping aside. That has a lot of people questioning what they will do moving forward. And then software questions, of course, have hit this stock as well.
Yeah, so look, if you got shaken out of the stock over the last 20 years, that's really not good because it's been one of the biggest wealth builders, I think the biggest on the TSX. And I think their strategy still can continue, which is a roll-up and continue to buy in certain areas and then have it be accretive and continue to grow. So I think that all, and you probably want to buy these when they're down. And I think what's happened uniformly across the board is investors have taken a dim view to software while AI has been the sizzle. I think that's the story more than anything else, combined with the CEO change. That said, we're modeling 18% growth, and it trades at 24 times 2027. Not bad, but that's similar to a Netflix. So am I ready to be buying it right now? I mean, gun in my head, if I had to say buy or sell, I'd buy. But are there other places that offer a little bit more upside, better risk reward? Slightly, yeah. But this is good. I mean, it's getting to the level where it's not bad.
I guess a lot of people who do hold Constellation, as you mentioned, or have held it for a while, are wondering now what to do, whether to continue to hold, whether to sell some of it off. Is there a comeback that's possible? You said you saw 18% growth that's possible?
18% is what the market believes. The market believes, if you take a look at all the analysts that are covering it, I don't know how many there are, maybe 20 or 30, and these guys are paid a lot of money to do this. They think that they're going to grow compound annual growth rate 18% over the investment horizon, that which can be seen. That's pretty significant. The problem is it's trading at 24 times, which is a little pricey for that growth. I mean, NVIDIA is a cheaper stock on a price to growth basis. So I'd rather go into something like that. But if I have it, and if I'm going to pay 25% gains, capital gains, I'm not selling it. If I have some in the registered accounts, I would have shaved. I'm not going to shave at these levels when you're on a trend line right now, which looks probably like it's down on its 200-day on a 10 or 20-year chart.
Okay, good to know. Let's move on to Ray, who's calling from Pickering, Ontario. Hi, Ray.
Oh, hello. Happy Friday. Greg, you speak to me today with this wealth protection strategy, because this is my RRSP. So, this is something serious in my life and, my going forward. And so I was wondering what you think about holding something such as Fairfax Financial. I don't have any insurance holdings in my portfolio right now, and this is seems to be a well-run company over many, many years. And maybe, Morella, if you could check what the analyst recommendations are, if this is a buy or hold at this time.
Okay, thank you for the question. Fairfax Financial, very well known. What are your thoughts?
Well, they've done everything right. This was a top pick at around $500 maybe 3 years ago, not too long ago. And, it went from being dead money for several years to just being on fire. They really increased their book value per share growth profile. They've really increased their underwriting ability. Company does benefit when there's lower catastrophic losses, which happened last quarter. Robust operating income. Pricing has been, a little better by and large. Buybacks, dividend growth, all these things that you get in the stock. Would I be buying it right now? It's 12 times 2027. I don't see too much growth for 26 and 27, other than rising book value per share. So I would take a pass. I think that there's more dividendy stocks in this for a registered account, but it's a good quality, fine holding.
Okay, and Ray had asked about analysts. They are saying 6 buys, 1 hold, 1 sell. So some good information to put to use there. All right, let's go to our next caller. We have Lawrence on the line, and he is calling today from London, Ontario. Hi, Lawrence.
Good afternoon. Could you give me your suggestion on buying Keyera or Gibson Energy? And if I bought them, what would be a good stop-loss spot?
Okay, thank you for the question. Do you want to start with Gibson?
Sure. Listen, they're both really good. Keyera's got better growth now, but it trades at a much higher valuation. Gibson is, trading maybe around 13, 14 times with still a very good growth rate. They just had their investor day. They're targeting strong investor growth. I like them both a lot. In terms of stop losses, don't do them. Don't do them for these stocks, okay? Like if you want to do them
Why?
Okay, so you do stop losses. These are, if you don't have conviction, you don't want to own it. If it goes down 10, 15%, which is very usual for a stock, good stocks can go down 30%. It doesn't mean that the news flow has changed. If you don't like what you own, follow it and start to pare it back if it goes from a conviction rate of 8 out of 10 to 7 out of 10, 6 out of 10, and start taking it down that way. Don't get snapped out by the market, because usually those stop losses, what happens, I mean, they sound really good. They sound like the elixir, right? But usually you're stopped out, stock starts to go back, and then when do you get back in? You get back in, another stop loss gets stopped out. They do so much harm. If you're going to trade futures, leveraged futures, oil or something that, is hit and miss, or maybe a Bitcoin, which is the whims of investor appetite as opposed to a thesis that you understand and in catalysts, then you can use stop losses. But not for these good companies that are paying you 6-7% to wait. And if they're not investable down 10%, just don't invest in them.
Okay. Let's get to one other caller. Jim is on the line from Peace River in Alberta. Hi, Jim.
How you doing?
Good. What's your question?
My question, in January, I'll put $7,000 into my tax-free savings account. I'm wondering about Canadian Natural as an ad and holding them over the next 5-10 years. What do you think, please?
Okay.
Thank you.
CNQ has gone sideways quite a bit for quite a long time. And the price of oil might be playing into this, although I do know they make money even at the level oil's at today. What are your thoughts on a little bit of a comeback here, or is it going to be dependent on what oil does next year?
I think you really answered that question really well, really well.
You're the expert.
Okay, so listen, CNQ is profitable down to West Texas, I believe, below 50, which is great. And I don't have a great view of oil prices because I think that Trump wants to keep them lower, and I think that there's a lot of competition and that sort of thing. But I do think that the Canadian names, which have a lot of ground to make up, and so I think that CNQ is one of the best to buy. I think it's got a natural gas play, which is very good here, and they have great operations. They're not cheap relative to their peers, fair price, but this is probably, your best big oil play in Canada, in my view. And I do like the natural gas kicker, and I really like that they're efficient down below $50, which I don't think oil should go lower than that. So I think it's a great idea, and with a nice 5% dividend.
All right, that was for Jim in Alberta. We're going to take a quick break. We have Greg Newman answering your questions today. We're back in just a moment. Stay tuned. Welcome back. Let's get to an email from David. He says, just wondering if you could comment on Brookfield Infrastructure and where do you see the stock price in 12 months? Brookfield of the large Brookfield Group at $49.47 is where I have it today. Do you have a price target for Brookfield?
We have a price target of $41. So that would be about 14% north of here, I guess. You combine that with 5% distribution growth, and there's your return. Last quarter they had a little bit of softness in midstream and transport, but Q3 was solid again in data and utilities. These guys are an asset recycling and business.
You have a price target of 51?
Pardon me, 41.
Because we have it at 49.37.
That's right. This is Canadian dollar price. Sorry.
Got it. Thank you.
So we're
I missed that.
41 US dollars.
Got
yeah.
it.
So they got this great growth pipeline, new acquisitions as part of their growth strategy, the U.S. pipelines and fiber deals that have just closed. They announced a new acquisition of New Zealand natural gas infrastructure. They got a $5 billion contract with Bloom Energy, which investors really might realize is been a real go-go name over the last year. And they reiterated their sales target of $5 to $6 billion over next 2 years. So these guys, bottom line, they have inflation-linked revenues as far out as the eye can see, trading at a reasonable 10 times 2027, growing at 15%, with a nice dividend distribution, with nice distribution growth, and a 91% payout ratio. So most of the time, this name is a very nice risk reward, and I like it.
Between the Brookfields, is it the infrastructure play that you like?
That's a great question. They have a lot of good plays. They really do. Like I like the parent, and there's times when BN is a better price than BAM, and sometimes BEP, got very, very cheap after Trump won, and then they've done all these deals with Cameco and data centers, and so that has been ignited, but it's a little bit expensive. Of all of them right now, from a risk reward, BIP.UN would be my favorite.
All right, let's move on to a phone line call. Bruno is calling from Burlington, Ontario. Hi, Bruno.
Oh, hi. Thank you for taking my call. Greg, you mentioned TELUS, and my question regarding TELUS, Enwasol, the CEO, mentioned that he's got a financial plan for 3 years where he's going to pause the dividend increase, and he's going to drop the DRIP. And he mentioned something about 75% payout. Do you think that is sustainable? And the reason why I'm asking is because last time I heard a telecom company say that was BCE Bibic, and he cut. So do you think he has the credibility and the financial where to do this? I'll hang up and listen to your answer. Thank you so much.
Thank you very much for the question. BCE, we just remind people, parent company of the channel under Bell Media. TELUS cutting the dividend, BCE did earlier in the year. Moving forward, do you see a rebound for TELUS?
I think the viewer has a really good question there. First of all, I think that the CEO of TELUS has been a great bastion of capital for a long time. The industry's changed. The immigration landscape has changed. The debt profiles have changed. So, these things happen. I think that their key is asset sales. They have to sell real estate. They got to sell, some towers, other infrastructure to really help their. And I think also freezing the dividend growth is the right thing to do. And all in, I think you need to see some discipline happening in the marketplace for wireless, for these names to really start to turn around. Unfortunately, we really haven't seen that. Like recently, you've seen, I think, Freedom and some of the other ones start to cut their prices, which isn't great. That said, 15 times earnings for not a bad growth profile for this dividend. I'd really be more of a buyer than a seller.
The telecommunications space, you mentioned selling assets perhaps is something that they could work on moving forward to increase. I know they've started doing that, or TELUS has started doing that, selling towers or part of their towers.
Yeah.
Is that sort of a viable option for the company?
Yeah, I mean, asset light, that is the model that the U.S. carriers went and did. So I think they just kind of got to follow what their brethren in the United States have done, and I think that they'll be in okay shape.
All right, let's go to Jack then. Jack's on the line. He's in Toronto with a question. Hi, Jack.
Hello, good afternoon to you. And I would like to ask the gentleman about Shopify. It's been gone up and it's gone down. I just want to know if I sell it or keep it.
Thank you for
very
the question.
much and have a nice weekend.
Shopify is a volatile stock.
Yeah.
It got a boost after sort of Black Friday and doing booming sales in that period. Is this a stock that you invest in? Would you trim it at the point it is today, 220.52?
Well, we did. This was a top pick in 2016 at $36. And I think since then, I don't know how many times it's split. So we have some of it on the books from the very beginning. And the knock on the stock right now is it's incredibly expensive, but they're executing, they're everywhere. You really have to use the chart when to buy it. Do you sell it now? Look, it's very richly priced. Do you own it in a non-registered account? And are you going to pay taxes in April? I think that would be a big factor because whatever you put the new money, it's got to be 25% better to justify selling it. Look, I think, good good stocks have a way of shaking investors out, like we talked about with Propel. Really, they want to be light so they can go higher, so less people can own them, and it's just what happens. So I think it's a long-term winner, but it's definitely expensive, and I don't know that I'd be adding right here, right now.
All right, we're going to take another quick break. Then we have Greg's new picks when we come back. Stay tuned. Join us on Monday for Market Call. Darren Sissons on the show, partner portfolio manager from Campbell Lee and Ross Investment Management. He'll take your questions on global and technology stocks. That is on Monday. And time now for new top picks from Greg Newman. We're going to start with iShares U.S. Aerospace and Defense. So the ETF is ITA on the NASDAQ, a play more broadly for aerospace and defense, which you think will do well.
Or in Canadian dollars, you could buy XAD on the Canadian side. Same thing, same play. Look, I'm all about going for easy wins. Golden Dome will be a major growth driver. We've seen how good the U.S. systems are in the latest conflicts. With Israel and Iran, for example. Everybody's spending on military. Canada's spending on military. Germany's spending. The Middle East. Just recently in the last month, RTX, GE, Northrop Grumman, RTX, Lockheed Martin, they're all cite higher demand. GE raised their full year defense sales by 84%. It just tells you how much growth is going on. This isn't cheap. It's around 27 times forward, but I think that there's a lot more to go. I do own the individual stocks. I own Boeing as a value play. I own GE as a growth play, but this is just an easy, succinct way to own the sector.
And it's at 200 or 201-ish, and you'd buy in here.
I would.
All right.
Yeah.
Okay, let's get to your next new pick, which is IWM, another ETF. This is a play on the Russell 2000, so IWM on the New York Stock Exchange. Why do you want the Russell 2000 in your play?
Cheaper than the market, not owned that much, really under-owned, I would say. So I think that there's some diversification there. Small caps tend to do better than big caps over the long term, but they haven't for a long time. Very interest rate sensitive. You're seeing basically a broadening out in the rally and a differential between how well the Mag 7's doing and the rest. There's a bit of a catch-up going on. We're looking at the breadth, and the breadth's about 57% of stocks are above their 200-day moving average. So if you get interest rate cuts, if you get one next week, if you get two more in June, this is an area that should do really well, and it's under-owned, and it can give investors more diversification.
And you think there's a lot more catch-up to do for small caps?
I do, yeah.
For 2026?
Yeah, big catch-up, yeah.
All right. Okay, let's get to your third pick, which is a very well-known name. NVIDIA is what you're looking at. Off a little bit from highs, definitely, as people digest the AI spending and wonder what they're getting back. What do you like about NVIDIA moving forward? Clearly, you would buy in, I guess, at this point, 181.
Yeah, I would. And I guess, the knock is the circular buying. Amazon just came out with new chips, and Google just came out with new chips. Like, this is all in the last week. Everybody, if you ask...
Their competitors are emerging.
Right.
Yeah.
You ask a crowd of people, are we in an AI bubble? Everybody would say, yes, we are in an AI bubble. And people remember JDS Uniphase, and this can be a very cyclical area. So, you got legendary investors like Burry, for example, that are using put options, which is not the same as shorting, but he's... and there will be a tipping point for the stock, I promise, where you don't want to be in it. And margins will eventually have to come down. But I think these guys are way too early. The CEO says we're not in a bubble. And when everybody has their hand up that we're in a bubble, we're not. Bubbles don't happen when everybody's watching them, usually. Q3 was a beat and a raise. Blackwell sales are off the charts. Google, Amazon, Microsoft, they're all duking it out for AI. I don't think they want to be buying each other's chips to help them. I think that they like it, that there's an independent that they can get their chips from. So I think that that's preferable. And I think when you really step back, there's two things. AI proliferation is only 3% of U.S. corporations. The rest of the world is way lower than that. So AI is coming. It's going to change everything.
We've only dipped in, is what you're saying.
We are at 3%. The growth of this market is so big, people are misjudging it, and these guys are right there. Meanwhile, the buyback continues. They're buying back their own stock. They think it's cheap. This stock is trading at 24 times 2027 and growing at 38%, the analyst consensus. I think it's an excellent risk reward. And, everybody's declared, oh, I'm not owning NVIDIA anymore. I'm getting off circular investing, circular financing. And so I think they're wrong. And I think there's a lot more to go. And there's been a bit of a gut check here. And 180 is a fine entry point to buy more NVIDIA. Yeah,
that was my exact question. That's where you're comfortable still buying. Up to what, you think?
Well, you know what? Honestly, analyst consensus is $250. So that's where they think it's going in the next 12 months.
Okay.
But it's very situational.
All right.
Yeah.
Greg Newman, thanks for coming in. Have a good weekend. Appreciate your time.
Thank you.
And thank you for joining us today on Market Call. We'll see you back here again on Monday.